An exchange-traded fund, ETF, is an investment fund that holds a basket of assets. ETFs can include various assets such as stocks, bonds, or commodities, providing diversification. ETFs trade on stock exchanges like individual stocks, offering liquidity and ease of access. Certain ETFs are engineered to focus on high-growth sectors. These ETFs aim to achieve significant returns over a period. Targeting companies with substantial growth potential is a key strategy. Innovation ETFs target companies that are disrupting existing industries. These ETFs also focus on companies creating entirely new markets. Innovation ETFs provide investors exposure to cutting-edge technologies and emerging trends. Technology ETFs focus investments in companies across software, hardware, and semiconductor industries. These ETFs provide exposure to various tech-related fields, offering diversified investment opportunities. Technology ETFs include companies involved in software development, hardware manufacturing, and semiconductor production. Emerging market ETFs offer investment exposure to rapidly expanding economies. These ETFs include companies located in developing countries. Emerging market ETFs allow investors to participate in the growth potential of developing economies. Small-cap ETFs focus on investments in smaller companies. These ETFs offer significant growth potential. Small-cap ETFs are characterized by higher volatility. Revenue growth serves as a key performance indicator for a company. Revenue growth reflects a company's ability to increase sales. Revenue growth indicates a company's ability to expand its market share. Earnings growth reflects a company's increasing profitability. Increased profitability often indicates improved operational efficiency. Earnings growth is a key metric for evaluating a company's financial health and performance. Innovative companies often experience high growth rates as their products or services gain market traction. Rapid growth is a key indicator of successful innovation and market acceptance. The correlation between innovation and growth highlights the importance of continuous development and adaptation. High-growth ETFs are subject to greater price volatility compared to broader market ETFs. This increased volatility in high-growth ETFs reflects higher potential risks for investors. The concentrated nature of high-growth ETFs contributes to their amplified price swings. Concentrating investments in specific sectors elevates risk due to potential underperformance in those areas. Sector-specific risks can significantly impact overall portfolio stability and returns. Diversification across multiple sectors mitigates the impact of individual sector downturns on investment portfolios. Smaller companies are more susceptible to economic downturns. Smaller companies face increased vulnerability to competitive pressures. Limited resources and capital can amplify the risks faced by smaller companies. Prior to investing, conduct thorough due diligence on the ETF's holdings. Understanding the ETF's investment strategy is crucial for informed decision-making. The expense ratio is a key factor to consider, as it directly impacts investment returns. Due diligence involves assessing how an ETF aligns with your overall investment portfolio. Diversification is a strategy to reduce risk by allocating investments among various financial instruments, industries, and other categories. A well-diversified portfolio can mitigate potential losses by spreading risk across multiple assets. Assess risk tolerance to determine if the ETF aligns with investment goals. Evaluate investment horizon to ensure the ETF's timeline matches financial objectives. Suitability of an ETF depends on both risk tolerance and investment horizon. The expense ratio represents the annual fee for managing an exchange-traded fund, ETF. This fee is expressed as a percentage of the ETF's total assets under management. Expense ratios are crucial for investors to consider as they directly impact overall investment returns. Expense ratios of similar ETFs should be compared to ensure a competitive rate. Competitive expense ratios directly impact investment returns. Lower expense ratios can lead to significantly higher long-term investment gains. High expense ratios can diminish investment returns over time. Consider the cost-effectiveness of an ETF when evaluating its potential performance. Expense ratios directly impact the net profit realized from an investment. Profits from selling ETF shares may be subject to capital gains taxes. Capital gains taxes are levied on the profit realized from the sale of a capital asset. The specific tax rate depends on the holding period and applicable tax laws. Dividends paid by an ETF's holdings are generally subject to taxation. Taxable dividends reduce the net return on investment from ETFs. The tax implications of ETF dividends should be considered when evaluating investment strategies. Certain exchange-traded funds, ETFs, are structured to enhance tax efficiency. Tax-efficient ETFs minimize taxable distributions, potentially increasing after-tax returns for investors. Strategic ETF structuring can reduce the frequency and magnitude of capital gains distributions. High-growth ETFs are often best suited for long-term investors. Long-term investors should be prepared to withstand short-term market volatility. The long-term investment horizon allows for the potential to overcome temporary market fluctuations. Long-term investing necessitates periodic portfolio rebalancing. Rebalancing maintains the desired asset allocation and risk level over time. Regular rebalancing ensures alignment with long-term financial goals. Regular monitoring of ETF performance is crucial for long-term investing. Adjustments to ETF investments should be made based on predefined investment goals. Consistent monitoring and strategic adjustments ensure alignment with long-term investment objectives. High-growth ETFs present the potential for substantial returns. Investing in high-growth ETFs involves inherent risks that must be acknowledged. Thorough research is crucial before investing in high-growth ETFs.